All right, welcome back to our crypto trading tutorial for beginners. In this part, we're going to add a really powerful tool to your trading arsenal, the moving average. Look, if you've ever felt totally lost in all those chaotic up and down price swings, this is the tool that's going to help you finally see the big picture. Okay, so here's what we've got on tap. First, we'll see how this new tool fits right in with everything you already know. Then, we'll break down what a moving average actually is. After that, I'm going to show you a super simple way to read it. And finally, we'll get into a legendary trading signal that uses this exact tool, the famous golden cross. So let's just dive right in. You know, the best tools aren't always the most complicated ones, right? They're the ones that build on a solid foundation. And that is exactly what the moving average does. It takes everything you've learned so far and just makes it that much more powerful. First off, let's just take a second to appreciate the toolkit you've already built. I mean, it's pretty awesome. You can read candles to see the immediate blow-by-blow price battle. You can spot support and resistance to map out the whole battlefield. And you use volume as your own personal lie detector to validate every single move. Seriously, you're already way ahead of the curve. But there's a problem that every single trader faces. And I mean everyone from a total beginner to a seasoned pro. The daily chart is just, well, it's noisy. Prices shoot up, they dip down, and all these little zigzags make it incredibly hard to tell which way the market is really heading. It is so easy to get faked out by all that noise. So what's the fix for all this chaos? Well, it's something called an indicator. I want you to think of an indicator like a pair of noise-canceling headphones for the market. Its whole job is to filter out all that distracting short-term noise so you can finally hear the music. You know, the real underlying trend. And the very first indicator we are going to master is one of the most popular, most powerful ones in all of trading, the moving average. And yeah, as you can probably guess from the title here, its entire job is to smooth out all that noise for us. So what in the world is it? Well, a moving average, we'll just call it an MA for short, is really just a simple line on your chart. What it does is it calculates the average price of an asset over a set period of time. And by doing that, it just smooths out all those wild daily spikes and dips, revealing the true underlying direction of the market. That's it. It's that simple. And this slide just perfectly shows the magic of the moving average. Just look on the left. That's the raw price action. It's total chaos, right? It's almost impossible to feel confident about where the trend is going. But now, look at the right. The moment we apply the moving average, we get this single smooth line, and bam, suddenly there's clarity. The real direction becomes totally obvious. Now, you're going to see traders use all sorts of different time periods, but honestly, these two are by far the most important ones you need to know. First up, you've got the 50-day MA. This one's perfect for getting a handle on the medium-term trend. Then you have the 200-day MA, and that one is the big kahuna. Think of it as the ultimate benchmark for the long-term health of the entire market. Okay, great. So you have this line on your chart. Now what? I mean, how do you actually use it to make trading decisions? Well, I'm about to share a really simple analogy that's going to make this incredibly easy to remember. I call it the swimmer and the log. Here we go. I want you to really lock this picture into your mind. The smooth moving average line, that's a log, just drifting gently down a river. And the price, with all its frantic jumping around, that's our swimmer in that same river. Okay, so here's how it plays out. If our swimmer, the price, is floating above the log, it means the river's current is strong and it's pushing everything upstream. This is a classic bullish sign. It's showing real strength. But if the swimmer is below the log, well, now the current is dragging them downstream. And that's a bearish sign. It's showing weakness. It honestly is that simple. Price above the line is bullish. Price below the line is bearish. All right, so you've basically mastered reading one moving average. But what happens if we put two of them on the chart at the same time? Well, that's when things get really interesting, because that can create one of the most watched signals in all of trading, the famous golden cross. So for this signal, we need two main players on our chart. First, we've got the fast line. That's our shorter-term 50-day MA. So why do we call it fast? Well, because it reacts much more quickly to recent price changes. Simple enough. Our second player is the slow line. That's the long-term 200-day MA. And you guessed it, we call it slow because it takes a lot more time and a whole lot more price movement to change its direction. Okay, so let's put the puzzle pieces together here. Imagine the fast line, which represents recent short-term momentum, crosses above the slow line, which represents the steady, long-term trend. What do you think that's telling us? I mean, what kind of awesome name would you give a powerful bullish signal like that? You got it. It's the golden cross. When that faster, short-term momentum literally surges past the long-term average, traders see it as a major signal that a new, powerful uptrend could be starting. And of course, as you can see on the right, the opposite is also true. When the fast line crosses below the slow line, it gets that much scarier name, the death cross. And that is a major bearish signal that traders take very seriously. If you need a daily analysis of the market and useful tips about crypto trading, subscribe to Trade Compass and hit the bell. See you in the next part.